Welcome to today's Explainer. If you've ever wanted to pop the hood of a massive business and see exactly how its financial engine purrs, well, you are in exactly the right place. Today, we're taking a masterclass that demystifies the strict mechanics of accounting. We're going to journey from the most atomic, foundational rules that govern every single business action, all the way up to the ultimate financial metrics that determine a company's success or failure.
Okay, let's dive right into today's agenda. We're taking a micro to macro journey. We'll start with 1. The accounting equation. Then 2. The accounting cycle. 3. Tracking inventory systems. 4. Book versus market value. And finally, 5. The hierarchy of profit. Let's get to it.
Starting with Section 1, the basic accounting equation, the skeleton of business.
Think of this equation as the absolute skeleton of any business. Assets equal owner's equity plus liabilities. This right here, it's the bedrock of accounting. Let's make it real and ground this in a concrete example. Say you decide to start a neighborhood bakery. The commercial ovens you buy and the cash sitting in the register, those are your assets. Now, if you took out a massive bank loan to buy those ovens, that loan is a liability. But if you used your own personal life savings to fund the business, that is your equity. Every single time a transaction occurs in the business, it must affect at least 2 of these elements so that this equation remains in perfect perpetual balance. It literally never, ever breaks.
A fantastic way to lock this concept into your brain is this simple, super elegant rule. What the business owns equals who paid for it. The left side of the equation, the assets, is simply the stuff. It represents everything the business physically or intangibly owns. The right side represents who actually funded that stuff. Those assets were either funded by external creditors, which are your liabilities, or they were funded by the owners themselves, which is your equity. It's just a wonderfully logical, inescapable system that tells the whole story of a company's capital at a single glance.
Moving on to Section 2, the complete accounting cycle, the nervous system. So, if the accounting equation is the skeleton, the accounting cycle is the nervous system, processing raw, daily actions into polished final reports. It operates on a strict, predictable timeline. Daily, you have transactions occurring which generate source documents. Monthly, those documents are summarized into journals, posted to the general ledger, and checked with a trial balance. Finally, at year-end, we see adjustments, the creation of final financial statements, and detailed analysis. But here's the critical takeaway you cannot forget. It all starts with a source document, a cash slip, an invoice, a credit note. In the strict accounting world, if there is no source document acting as absolute proof, the transaction literally did not happen, period. If the auditors come knocking, without that slip of paper, your numbers mean absolutely nothing.
Now, to memorize this whole chronological cycle, you can use this brilliant 9-step memory trick. The smart journalists love to analyze company financial figures. It maps perfectly to the entire process: transaction, source document, journal, ledger, trial balance, adjustments, closing entries, financial statements, and finally financial analysis. If you can commit that single sentence to memory, you have the entire functional nervous system of modern accounting memorized from start to finish.
And you know, that final step, financial analysis, is where all this rigorous record-keeping actually pays off. This is the stage where raw, unorganized data magically transforms into polished, actionable corporate insight. It's where investors, banks, and internal stakeholders finally get to interpret the true health and trajectory of the business. All the daily source documents and monthly ledgers culminate right here.
Next up, Section 3, Tracking Inventory Systems, Managing Goods. How does a business actually track its physical products? Well, they generally use one of 2 main systems. The perpetual system updates stock continuously with every single sale. Think of scanning a barcode at a high-end electronics store. They instantly know their exact gross profit on that single television the second you buy it, because the system updates perpetually. Contrast that sharply with the periodic system, where cost of sales is only calculated at the end of a specific period. Why do this? Imagine a massive lumber yard or a wholesale hardware store selling millions of loose nails. Tracking every atomic unit instantly as it leaves the store is nearly impossible. So instead, they calculate the bulk cost later by taking what they started with, adding what they bought, and subtracting what's left.
Let's look a little closer at how you calculate cost of sales in that periodic system. You take your opening inventory, add everything you purchased during the period, add your carriage, and then subtract your closing inventory. Notice that specific word, carriage. That means transport costs. It is totally crucial to understand that the cost to transport goods is not just some extra administrative fee, it is directly baked into the fundamental worth of the goods. Transportation is quite literally part of the cost of sales.
All right, Section 4, Valuing a Business, Book versus Market Value.
When evaluating a business, we're really dealing with two very different realities. Book value is your baseline, rigorous accounting reality. It's simply assets minus liabilities. It is the exact net worth mathematically recorded in the company's books. Market value, however, is calculated by multiplying the number of outstanding shares by the current share price. This represents what real investors are actually willing to pay for the company in the open market. And because market value relies so heavily on investor sentiment, future projections, and public perception, these two numbers almost never match. Book value looks at the hard, cold math of the past. Market value looks at the emotional, speculative promise of the future. Let's look at a wild, real-world example using Woolworths to see this gap in action. On their books, they meticulously recorded 40.8 billion rand in assets and 30.1 billion in liabilities. That leaves a hard accounting book value of exactly 10.7 billion, or roughly $11.99 per share. But out in the wild, because of immense investor optimism and brand trust, the shares were trading at 54.26. That gives the company a massive market value of 48.5 billion. The market's perception completely and totally outpaced the strict accounting reality by tens of billions of rands. And that brings us to Section 5, the hierarchy of profit, the vital signs. To truly grasp the vital signs of a business, we're going to use a progressive disclosure technique. We'll systematically peel back the costs, layer by bleeding layer, from our top-line gross revenue to discover the true, surviving bottom line that the owners actually get to keep in their pockets. Let's trace the journey of 6 million rand in gross revenue down the hierarchy. Right off the bat, we strip away customer returns, dropping us down to a net revenue of 5.5 million. Then comes the direct cost to actually make or buy the product, our cost of sales, slashing us down to a 3.5 million gross profit. Next, the everyday costs take a bite: rent, salaries, marketing. We deduct those operating expenses to find our operating profit at 1.5 million. We subtract admin costs to hit our EBITDA, sitting at 1 million. Finally, we remove depreciation, the cost of interest on our debt, and of course, the taxman's cut. After all that bleeding, the owners are left with a profit after tax, or PAT, of 504,000 rand. That PAT is the ultimate surviving core of the business. Let's actually pause for a second to formally define that massive financial buzzword we just blew past, EBITDA, earnings before interest, tax, depreciation, and amortization. Why is Wall Street and the entire corporate world so completely obsessed with this specific metric? Because it isolates the pure day-to-day operating engine of the business. By deliberately ignoring taxes and interest, it removes the effects of how a business is financed or where it is legally headquartered. It gives investors an incredibly clear apples-to-apples look at how well the core business actually performs before the lawyers and the banks get involved. And that brings us to the end of our explainer. But before we wrap, I want to leave you with a provocative thought. If book value is strictly dictated by the rigid, unbreakable rules of the accounting equation, but market value is driven wildly by external human emotion and perception, how can mastering these dry accounting cycles give you a massive competitive edge in the real world? Well, when you know exactly how the numbers are built from the ground up, you hold the power to shape the entire narrative of a company. Thanks for joining me on this explainer, and we'll see you next time.